And it's not just the Fed that needs to make decisions without data. It's this market. As we exist in this black hole and try to parse through alternative data sets, how much conviction can you have on fixed income and where yields go during this government shutdown?
So listen, by the way, I've said it for a long time. One of the ways we actually get really good data is corporate data. Like I've found, like I think survey data is interesting. I tend to think it's skewed. It tends to move with sentiment, tends to move, quite frankly, I always find with the S&P 500 moves a lot of these surveys. What I focus on, and what I more so, obviously we need to get the data. We need to get the payroll data. That is good data generally. What we need to get, what I think is fascinating, and particularly in today's world, is you look at some of the corporate numbers and you look at what's happening with hiring, what's happening with productivity, how are they managing inventories. Listen, more data is better. We do loads of things with AI now and looking at how you scrape the internet, how you look at credit card data. So anyway, this is one of the pieces you'd like to have, but you certainly don't feel like you're operating in a vacancy.
I mean, I was just talking with Mike McKee about this during the break, and I don't know how much granular data you need to know that core CPI is going to be about 3%, right? It seems to hang out there forever and everybody's fine with it. So what are the most important pieces you're looking for? Is it on the labor market as opposed to on the inflation side?
Matt, I mean, it's such a funny thing. I've been doing this a really long time. I'm always blown away that we sit around, and particularly in my business, we sit around and wait for that CPI report, and it's a couple hundreds of a percent that seem to shift sentiment one way on inflation. At the end of the day, it's actually not that big a deal. To your point, we're operating price stability. It's actually at a pretty extraordinary level. We're ticking up a little bit because of tariff transmission. That is a big deal, and obviously in the short term. But our sense is that's going to come down, a la productivity, et cetera. To me, it is for the next 5 years, the most critical piece of information is going to be labor. I do think that productivity, innovation, technology, you think of the amount of money that's going into it, will ultimately bring down wage pressure and will bring down, consequently, will bring down inflation. Labor, to me, is a big deal. Think about what's happened the last few months. You're actually watching the economy. We print, 3.8% real GDP. The economy, we think for the year, is going to print over 5%, 5-ish percent. Nominal GDP. Companies are printing tremendous earnings reports, but they don't need the same amount of infrastructure. Labor, you look at what's happening to SG&A, cost of goods sold, labor. Much productivity is happening. It's not like AI is 2 years from now. Productivity, not just AI, inventory management, logistics, how you run your business more efficiently. And by the way, part of what's playing out is companies gaining scale. They're trying to get scale because you think about how you can run your business, higher margins, lower cost infrastructure. Long-winded way of saying, we need to keep more people employed in this country, and I think the primary trend or the primary focus has got to be let's keep full employment where it is for however we get there.